you. Yeah, so hello guys, welcome everyone. Welcome today. Good evening to everyone in the Finance and Investment Society. Today, me, Shikhar Mankani, along with Ruhan Bajaj, are here to present you a session on how to select stocks for short-term trading. This is presented by the Finance and Investment Society of our college, Shahid Bhagat Singh. So I'll give you a short intro about myself and then proceed. My name is Shikhar Mankani. I am also a fresher from first year studying in BCom honors in Shahid Bhagat Singh College, like you guys. And since COVID times, I had a huge interest in stock markets, trading, and stuff. So that is what got me into this field. So today what we learn is basically how to select stocks for short-term trading, and that we'll study about the key strategies that is involved in selecting stocks, how to select stocks, and more importantly, when to select the stocks. We'll be learning about the concepts of technical analysis and also about trend lines, trends, chart patterns, candlesticks, and related stuff. This session is also divided into two parts, today and tomorrow. So today we'll cover the trends, trend lines, candlestick patterns, and chart patterns. So let us start with understanding what is short-term trading. First of all, basically there are two types of trading: long-term trading and short-term trading. Long-term trading is also sometimes people consider it as investing. Long-term trading involves buying and selling securities within a long period of time that can range from months. Theoretically, it says buying and selling securities over a period of 1 year, but it also can vary from 1 to 2 years. Short-term trading involves quickly buying and selling assets and securities. That can vary upon minutes to weeks, depending on what is your style, what is your choice, what is your risk tolerance, and what are your goals. It requires strong market knowledge. Again, short-term trading involves strong analysis of the stock and less about the company. It involves strong analysis about the price and about how the market is going in that period of time. Risk tolerance, obviously, risk tolerance is a huge point to consider when trading short term, unlike long term trading, and it uses day and swing trading methods. Okay, first of all, I'll explain what are the types of traders in short-term trading. So first we have swing traders. Swing trading is basically buying and selling. Your time period, your time frame can vary upon uh, within a few weeks and days. So that is what swing trading is. Then we have day trading, buying and selling securities in the same day, and we have a concept called scalping, which we'll not touch in this session, but I'll tell you what it is. Scalping is basically entering into a stock, and exiting it as soon as it returns in your favor. So it involves quantity over quality. That is what scalping is. But we'll basically be studying about swing trading. That is the most simplest and easiest form of short-term trading. Stock selection is essential always in the short-term trading, as the right pick can yield quick gains, while a poor choice may cause losses. Traders usually prefer liquid, easy to cash out stocks, volatile stocks using, and how they pick stocks is by screening out the bad stocks. And how they do that is by using fundamentals, by screening out the bad fundamental companies and selecting those stocks. But in my opinion, a more important aspect of selecting stocks is not what or how to select stocks, but is how when to entry. So yeah, they also use technical analysis to match stocks with their strategy. Let us now understand stock short-term trading in brief. By theoretically, it says that it refers to those trading strategies in which the time duration between entry and exit is within a range of a few minutes to a few weeks, as explained by me. That short-term trading basically involves buying and selling securities within a few days and booking profits quickly. So the time frames. So first of all, what I mean by saying time frames is that when we use a chart, we see a candlestick in the chart. So in case you all don't know what candlestick and what time frame is, mm, so I'll just explain that. A day trader can use 15-minute charts for trades, 60-minute charts to identify the primary trend, and 5-minute charts for short-term trend insights. So day trading involves buying and selling securities on the same day. So a day trader, as written here, can use a 60-minute chart frame to analyze the long-term trend that is going on according to a day. Again, his goal is to sell the security at the same day, so he'll use a shorter time frame to analyze the longer trend. And meanwhile, the swing trader, as their goal is to buy and sell securities within days and weeks, will use the primary trend of about some days or some weeks, and a 60-minute charts to define the short-term trend. The goals of short-term trading is again booking profits quickly as compared to long-term trading. Typically, the goal is to quickly profit by leveraging market volatility and short-term price movements through identifying advantageous entry and exit points in brief time frames. Yeah, I hope you guys understood what is time frame. So while trading short term, traders usually think that everything is technical analysis, and all we have to do is look at the price movement and look at the charts and stuff. But it's not just that. It's not that simple. We also have some factors to consider, some external factors to consider in the environment, which includes market conditions, economic indicators, news and events. Market conditions basically are the factors like economic trend, investor sentiment, how the market is going, what is the volumes, are people buying, are people selling. So that is what market conditions are. And volatility levels that influence stock prices and trading opportunities. Economic indicators, as we have all studied in our 11th and 12th grade, it includes GDP growth, inflation, and employment rates, signaling economic health, interest rates. What is RBI doing? Is RBI increasing interest rates or decreasing the rates? That is also a huge indicator and a factor to consider while trading short term. And that helps investors assess potential investment opportunities. So suppose RBI reduces the interest rate. That makes it easier for borrowing, which makes it better for the business to grow. That is a good buying opportunities for traders, and people use it. News and events, the biggest factor to consider, not theoretically, but I'd say practically, news and events play a big role in short-term trading, as people's sentiment vary from while seeing the news and events. I'll give you some example. So we all know about the Hindenburg crash. When Hindenburg published its first report about Adani, and I guess you all know that how the whole Adani portfolio crashed to about 50 to 70%. So that's how news and events affects the market. Even the Israel war, the Ukraine war, it wasn't related to our country, but still it was bad news and a bad event that affected the market sentiments and the investor sentiments, which basically affect the price and the markets. Earnings reports, economic data, and geopolitical developments can be considered as news and events. They trigger rapid price changes, influencing trader sentiment and short-term market volatility. Okay, these were the factors to consider, the external factors to consider, I'd say. So, traders believe from a long period of time since history that the price of a stock moves in a particular pattern, and it's not just anything that it moves by its means, but it will always move and show a particular pattern in its price movement. So theoretically, trend is the direction that prices are moving in. Based on where they have been in the past, trends are made up of peaks and troughs. It is the direction of those peaks and troughs that constitute a market's trend. Or whether those peaks and troughs are moving up, down, or sideways indicates the direction of the trend. Again, why do we have to notice a trend in the market? To identify opportunities, buying and selling opportunities. And yeah, that is why we have to analyze and spot what is the trend of the market and the stock price. So again, in technical analysis, we have a tool that can be used in identifying the trends and can make your trend identifying more accurate and better. So I'll explain there are three types of trend. Majorly, there are three types of trend. One is an uptrend. Uptrend is made up of ascending peaks and troughs, higher highs and higher lows. Uptrend, in simple words, is basically when the stock price keeps going up and shows a pattern that is going up continuously. Downtrend is the complete opposite of uptrend, which is made up of again lower highs and lower lows. As explained, downtrend is the complete opposite, and the price is continuously moving downwards in a similar pattern. Sideways trend is when price moves sideways, when it goes up and down, but it stays within a range. That is what sideways trend is. I'll just briefly explain a simple concept of trend's length, which is not that important, but then I'll move into the practical aspect of it. Trends are affected by the next longer and next shorter trend. We have bigger time frame trends and shorter trends, as explained in the time frame part, that traders can use the long term trends to analyze what is the trend, and the short term charts to identify buying and selling opportunities. A rising long term trend causes the intermediate trend to have larger rallies and smaller retracements, and the short term trend causes the intermediate trend to ebb and flow. A falling long-term trend causes the intermediate term trend to have similar rallies and larger retracements, while the short-term trend again causes the intermediate trend to ebb and flow. We basically have trend lengths, three types of trend lengths. Primary, which is the long-term trends, 1 year or longer. We use it to identify how is the history of the market is moving. Secondary is the intermediate, 3 month, 1 to 3 months. We use it to analyze how the market is moving currently in the present time. Minor is which is below less month. That is certainly used for identifying opportunities. Now, since we have discussed upside trend, downside trend, sideways trend in theory, but I know that is not the viable part of learning. So I'll move into the practical part of how to draw trend lines and how to correctly identify trends. I have some examples for you guys. First, you have to open a chart. We can open charts in various softwares and various websites. We have investing.com, TradingView, and some are paid ones, but these are not. I'll be using investing.com today for my analysis. Just share my screen again. So first, let us discuss an uptrend. All right. Ruhan, is it visible?
Yes, it is.
Yeah, thank you. So first of all, when we make a trend line, we select this option. Let's delete this. We'll select this option and draw a line on the chart. Okay, this is a candlestick chart. We have Rohan to explain candlesticks in brief later, but I'll just give a short explanation. As previously told by me, time frames. I have selected the 1 day time frame for this chart. That what it means by 1 day is that this particular candlestick shows the movement of the price of. I have selected the Tata Consultancy Services chart. So this particular candlestick. So represents the price movement of the stock within 1 day. So this is 1 day, this is another day. Yeah. So how you make trend lines is by selecting this and drawing a line, and you need to identify swing points for the trend line. Swing points is basically the extreme points within a chart. So I can see one extreme point here, another here, and as shown by this chart, this price is continuously moving up. I mean, it has its lows and downs and ups, but it's still going up till this point. So this is a great example of an uptrend. How to make an uptrend is a trend line consists of support and resistance. Support is basically a line below the chart, which when the price touches this line, it bounces back up. So it doesn't go below this. To make a trend line, basically you have to capture as many as swing points as you can. Try more than two. More than two is necessary, but try to capture as many points as you can. So here I have 3 points. And again, trend lines are not accurate. It depends upon you on how do you make it, but it gives you an idea of how the price is moving and what how you can capture the opportunity. So here we have an uptrend. This is the support. As you can see, the price is coming to this line. It bounces back here and then goes up again. But then again, in the same direction, it comes back at this line. And we can see another swing point here. So what is high lows and lower highs? So in an uptrend, we have higher highs and higher lows. This is a higher high, and this is a higher lows, and this again is a higher high, and this again is a higher low. How we can use it as an opportunity for entry is by making this trend line. And suppose this the trader was somewhere here, so he could make an entry here and keep his targets above this point, above the previous high. That is how we use an uptrend. And we can also make a resistance. It's not necessary to make both support and resistance in an uptrend, but to identify correct targets, it can be said that it is used, although it wasn't necessary here. So yeah, that is how we make a trend line, again by capturing as many as swing highs as we can. Yeah, this was uptrend. I'll be giving you an example of downtrend now. So I'll give you the best example, which is the present scenario of our markets, Nifty 50. This is the Nifty 50 index chart, and the time frame is about 1 hour. So again, this is a downtrend, as if you must be targeting the market, targeting stocks right now. So you must know that the market is going downwards, and this is a great example of downtrend. This is the complete opposite of an uptrend, but this point is called as lower highs, and this point is called as lower lows. Again, the complete opposite of what I told in an uptrend. So how to trade by using trend lines is you try to go with the trend and not against the trend. In an uptrend, you identify and you try to identify buying opportunities, and similarly, in a downtrend, you try to find out selling opportunities. So while this trend was going on, a trader could identify this point and uh, keep a short sell, and then he could keep his targets at here, the previous lows. That is how you use a downtrend. So again, it's the complete opposite of an uptrend. Side trend is a different thing when the price is moving in a particular range and not going up or below that. I'll give you an example of side trend as well. And it also involves both resistance and support. Like as shown in this chart, this is the resistance as the price is not going up, and this is the support as the price is again bouncing back up and not going below this line. Also, trend lines are used for identifying breakouts. So suppose if there is a huge breakout here, so theoretically, again, it's not accurate. Technical analysis can never be accurate, but theoretically, the market is supposed to go up. I'll give you an example of sideways trend as well. So here I'm sharing the chart of ITC. Again, the time frame I've selected here is 1 day. So you can see the price is going sideways, and it's not going above this line or below this line, and it's not going up or not, and neither going down. It's going sideways. In a sideways trend, we have both a support and a resistance. Resistance again means the price is not going above this and going down whenever it touches this line. And in when considering support, the price moves back up. So how do you use a sideways trend? Is a trader could identify this trend and could take an entry here and take the exit of around this range. around the previous highs. Again, this is a fake breakout. This is called a fake breakout, but the trader should keep his targets on the support, on the resistance, and make an entry in the support. And vice versa, a trader could also short sell the stock when it touched the resistance and could keep his targets on the support. So that is what a sideways trend is. Yeah, I think we have covered sideways trend, downwards trend, and even upwards trend. So that is all in trends. Now we have Ruhan to explain further candlestick patterns, technical analysis, start patterns to you. Over to you, Ruhan.
Yeah, thank you, Shikhar. Hello, everyone.
Thank you.
I'm Ruhan. I'm a member of the new projects department at the Finance and Investment Society. I'll be covering the aspects of technical analysis, resistance, support, and different chart patterns. I'll just share my screen. Shikhar, just update me if it's visible or not. Is it visible?
Yes, it's visible.
Okay, so we'll start with a major, I'll say, the root of what a technical analysis is: resistance and support. Resistance is a price level from which the price of an index or a stock consistently falls. This is where the majority of the sellers are and are willing to sell. They believe the stock shouldn't be priced at what it is currently, and thus they sell in the making assumptions that it would fall in the coming sessions. And the opposite for support. Support is the price level where the buyers feel that the stock price or the index price is low enough and should be valued higher than what it is currently. Thus, they anticipate price moving upwards and thus buy, making the price go up. I'll show this with an example on HDFC Bank, India's largest bank. And yeah, so what you are currently seeing here, multiple rejections. What is this? All the participants in the market feel HDFC Bank shouldn't be valued at what it is currently, 1757. It fell down from here, again went up, fell down from here, again went up, fell down, again went up, fell down. This happens what? One, 2, 3, 4, 5, 6, 7, around 8 to 10 times. Currently, it is hovering around here, which means that people, the strength of the sellers is decreasing. Less people are anticipating it to fall and feel it is now fairly valued. Now, for the thing of supports, market comes down, goes up, comes down to that level, goes up, comes down again, goes up, comes down, goes up. Same. It happens again and again. Buyers feel that the stock price is undervalued and should go up, thus they buy. The stock market is always a battle between the buyers and the sellers. The one of the two sides who overcome the other, the stock price moves in their favor. So what's happening here currently is, I'll just tell you this. In the game of supports and resistance, we say the, like, when the amount of time it is touching either the support or the resistance, the same become weak. Like what's happening is it is touching it again and again and again. It is getting weak. When it touched it, it had a really big fall. It went up again, fell, but not that much. Went up again, fell. This was some event or something, I guess, that caused this much of a fall. It went up again, but now fell even less, and now it is hovering here, which says that the resistance is becoming weak. And for the case of support getting weak, I have an example, I guess. Yeah, so what's happening here is, like, I like to mention this. The supports and resistance are an approximate idea. They do not reverse from the exact same level every time. They can go up, reverse from a bit up or a bit down. Now, what's happening here in UPL? It's touching the support again and again and again, showing the strength of the sellers. Now, someday the buyers will not have that strength to give competition to the sellers. That's when the price moves down. What happened here? So I guess uh, supports and resistance is done. We'll move on to the next. Chart patterns. Chart patterns are just the movement of the candlesticks. They show a psychological, there's always a psychology behind the chart patterns formation. It would be a bit complex to tell you the psychology behind it. So right now we'll just go with what the chart patterns look like. So the first chart pattern, head and shoulders, as the name suggests, it creates a high, comes down. It creates an even higher high, comes down, then goes up, but not up enough to touch the previous high. For this, tell you in an example, we'll have HDFC Bank. Yeah. So what this is, as I said, you'll never get exact bookish chart patterns. You'll have to get a rough idea of what it is. It would be looking a bit uh, what unrecognizable, but when you switch charts, here it is. What is it? It's a double it's a double top. Sorry, no, head and shoulders. 1 second. Uh, Shikhar, if you can help me out with where we had the head and shoulders.
No, I couldn't notice about your chart. I think you should go back.
Back a bit. 1 second. It was in Delhi, I guess. 1 second. Yeah, sorry, I had the wrong time frame. Yeah. So what here it is called a head and shoulders. It goes up, creating the left shoulder, comes down, goes up again, creating the head, comes down, then goes up again, and then creating the right shoulder. This area, the base, is called the neckline. The stock below this gives a downtrend. It currently is. And to give an example of what a support plays here is this. Market had a reversal from here, and now again, after this beautiful pattern, it came down just to give a great 217 point, almost a 1% up move, exactly from the same point. This is how supports play its role. Yeah, now for triangle patterns. Triangles are of two types, symmetrical and asymmetrical. As the name suggests, This, what currently is shown in the figure, is an asymmetrical triangle. Symmetrical triangles have movements, have the angles almost similar to each other. For a symmetrical pattern, I'll take you to symmetrical pattern here is currently in formation, as I always had the charts already set up. This is what a asymmetrical pattern looks like, almost a horizontal resistance and then an inclined support. Now, what this shows the price to be bullish. The lows are getting higher. The price is moving up while getting resistance from the same point. Okay, so next up, the double tops and double bottoms. The double tops, in to be in simple language, we call it an M pattern. It forms an M. While double bottoms, the opposite, we call it a W. Double tops show resistance, a stock price taking resistance from the same level twice and then show a downfall. While double bottoms show the stock price take support from a point twice and then go up. Double tops and double bottoms are my favorite if I give my opinion. They are very much predictable and look good on the charts. So for double top, I'll take you to HDFC Bank. Yeah, with this example. Now this is what a double top is. The stock price moves up, comes down, moves up again, and comes down. This is the neckline. The stock price moves down, takes a retest, or I should say, it's somewhat, we call it a retracement, comes down, moves a bit up, and then comes down. And you can look at the fall. It's just beautiful. Now, to show what a double bottom is, I'll take you to HCL Technologies. This is what a double bottom is. I'll just increase the time frame and delete this. This is pretty much recognizable. The stock price moves down, takes support, goes up, comes down, again takes support, and then moves up and gives a really good up move of 17% in the short term, really short term. And if you hold on to it for a bit, a year, it has given you 34%. Warren Buffett averages 27% a year, so 34% is really good. And to again explain support a bit, as if you can see, it took support from where? From where it faced a bit of resistance and then again took support previously. The chart always respects, or not, I should say always, most of the time respects its levels, unless some news or economic activities can affect the charts. Yeah, so next up is indicators. So first of all, indicators should be a supplement to your research, to your charts. They shouldn't be relied on individually. Indicators are just to give you a confirmation, to help or confirm your bias, and not to trade just on the basis of what an indicator is showing. There are many types of indicators. We have covered four or five indicators here. The first is moving average. So what the moving average does is it's a smooth line moving across the price points. Moving average takes the average price of the past 50, 100, or 200 years and then moves according to what the price was, the average price. Moving averages are mostly used to, again, to supplement, to get, to find points where a stock has uh, to the price level the stock has come over the past years, or I should say months, depends on the moving average you are taking. For an example, I'll get you to Hindustan Unilever for the show 200 day moving averages. I have to add the indicator. Yeah, so what we're currently having is 50-day, 100-day, and 200-day moving average. I'll cut out 50 and 100 and we'll go to 1 day charts. Now, I personally, this just for education purposes, this is not a buy or sell recommendation. I'll just tell where I personally had some interest in Hindustan Unilever. Hindustan Unilever is a big company, probably won't give you 100 or 200% returns when you buy it at the top, but certainly getting it below the 200-day moving averages is showing it is somewhat undervalued. A stock, take an example. A stock was moving at an average level of 100 for 200 days, and now you're getting it at, let's say, 90 and 80. It's clearly showing that the stock is undervalued. That's the best time you can get it. So what this is, you get here, you get to buy here, you get at 24, 68, you make a good 10-12% return, comes to 27.50, again falls down. Let's suppose if someone took it here, 22.41, maybe 23.78, then the stock price has recently touched 3,000. This is what the general use of indicators is. Let's say I'm at the stock, I feel it's a hypothetical thing. Let's say I'm having a bit of bias of it going towards the upside. Let's say this W, and I find it undervalued. It's below the 200-day moving average or at the 200-day moving average. I'll surely get this because I'll expect the stock to expand in the future. Now, the next thing is relative strength indicator, one of my favorite. So, what this does is, let's say whenever a stock price is moving upwards or downwards, it's just because of the strength of the buyers or the sellers. Now, relative strength index shows you the strength or gives you an idea of the strength of the buyers and sellers and their trend. So, I'll add RSI. So, what you are seeing here currently is what is called an RSI, Relative Strength Index. So, what these levels are is there are two uses, major uses of RSI. First of all, the basic, what everyone uses, the oversold and overbought zone. What this lower level of the price band shows is that the stock is oversold. I mean, if you have the capability to sell a stock 100 times, and now you're currently at 98, 100, 95, it's showing that is it is oversold, and maybe it should the selling should stop in a bit of time. The same with the overbought zone. The stock, the buyers are almost next to exhausted. They won't be able to continue buying further. This is what the RSI does. Like when the stock price reached its top, what you're seeing here, the RSI had already reached its top. The buying continued for a week, and then it fell down. It almost crashed. If we just measure what it fell, gave a 20% fall. In how many days? In 40 days, approx 40 days. This is what the major use of simple use of RSI is. The other, a bit complex use of RSI would be the RSI divergence. To explain this, I'll take you to the chart of HDFC Bank. I'll yeah, let's say this. The stock price here made a new high. What this is? Oh, sorry. Yeah, the stock price made a new high, while the RSI didn't. RSI made a new low. What this was showing, the stock price was moving up, but the RSI was falling down. What this was showing is the decreasing strength of the buyers. The strength is decreasing. And what happened next? The market fell. I mean, the stock fell. What fall it was? It was a good fall, 40%. So this is what the basic use of RSI divergence is. This can be used on the opposite side for the buy side. I'll show you if there's some example present here. Yeah, I have an example here. So what happens here is the stock price makes a new low. The stock price makes a new low. This was the previous high, and this is the new, just below it. While if you look at the RSI didn't make a new low. What does this show? The sellers are not that strong. And what happens next? It forms a W here and then moves up. Again, not easily recognizable. Turn it to a line chart. Here's the W, a double bottom. So this is what the basic use of RSI divergence is. On to the next. Yeah, next we are with moving average, convergence, and divergence. So what the MACD does is it uses different moving averages, and then like 50 day, 200 day, 100 day, and then where the averages converge, it gets or gives somewhat a prediction of if the stock price should move up or if the stock price should move down. Again, it should be used with your research to confirm the bias and not just use the indicators to make a bias, because all these indicators are lagging. They give you the results after a day or two, or if you're in a monthly chart, a month or after a month or two. And then here comes exponential moving average. This is somewhat the same to moving averages, but I'll like get you to the chart here. Remove RSI. This is the moving average exponential or the exponential moving average. It has certain inputs that you can, the length of what, it's the length of the candles, 9 candles, 15 candles, different EMAs can be set. This is also somewhat just to supplement your research. This and these EMAs, these moving averages, they do not have a specific use. There are different strategies, different ways to confirm your bias. People use it. I'll have to go a lot in depth to explain this, but this is just the basic overview of what exponential moving average is. Yeah, so the next is volumes. Volumes show the amount of buying and selling that took place in the day. Different types of volumes again. I'll cover. Like what you are seeing here is the volume, the traded volume of the whole day. All these bars coming below. This shows that a lot of buying and selling took place. The color of the volume bars is just the same as the color of the candles. It doesn't suggest that like this is not just selling. This contains buying too. To take you to what delivery volume is, that shows how much the actual buying took place. We'll take a short detour here. We go to volume analysis, highest lowest delivery. Change to NSC script. We take Nifty 50. It's taking some time. I'll just show you on. Yeah. So what you are seeing here is delivery volumes, the amount of stocks or the quantity that was bought to the demat account. The volume that was previously shown contained trading volumes, delivery volumes, and everything. What you are seeing here is just the delivery volumes that the people bought to the demat accounts. Now, what does this delivery to trade volume show? 70% of the stocks of the quantity that was bought was bought to the bought to the demat account. It was bought for long term. It was a delivery stock and not trading. So this is what delivery volumes is. There are different types of volumes that can be used. Okay. So what does volume joined with price indicate? When the volume has a big bar and the price has also moved up, it shows a bullish sentiment. A lot of people have bought the stock, which would somewhat take it like it would move up in future. When the volume decreases, it's low volume, the stock price moves up, you should not be that confident on getting that stock or that index. While the price decreases and the volume again increases, it's bearish. A lot of anticipation towards the price going down. A lot of people have bought that. It's a bearish view. While when the stock price decreases and the volume too decrease, again, not much confidence in that move. Again, these are all just, these are never 100% accurate. They can give you a view. You can never make, you can never be sure of making money in the stock market. It's always just a game of probabilities. And this too is a game of probabilities. Take you to some example of volumes. Yeah, let's say this. The stock price gave a breakout. It moved above the previous high. The volumes below were sufficient, but still not going significantly above the previous volumes. What did it show? It showed that there was not much confidence in the stock price moving up. And additional, what I would tell you, something di- different from what the presentation we have prepared is, what you see here is the stock price consistently moving up. It is not stopping. It is not taking a halt. This is also an indicator that the buying may be exhausted here because there are always sellers. Someone sold at this point to bring the stock down, and he's still sitting there. Sellers are sitting here anticipating that the stock price should not move above this. This moves up continuously. Buyers have almost exhausted themselves. The stock price comes down. The sellers overpower them. This happens the same with the sell side view.